Proposed Accounting Standards Update, Comprehensive Analysis on the Disaggregation of Income Statement Expenses. Introduction. The financial world is abuzz with the Proposed Accounting Standards Update on the Disaggregation of Income Statement Expenses, commonly referred to as DISE. This comprehensive overview aims to shed light on the intricacies of this proposal, which has been introduced to address investors' growing demands for more granular information about certain types of expenses included in expense captions on the face of the income statement. The primary objective is to enhance transparency and deepen the understanding of a company's financial performance, especially for public business entities. Real-world example: consider a multinational corporation like Apple Incorporated. With diverse operations spanning manufacturing, software development, and retail, the income statement can be complex. Investors might want to know how much Apple spends on manufacturing costs versus employee compensation in its retail stores. DISE aims to provide this level of detail. Background. Historically, the income statement presentation requirements for public companies, especially those in the manufacturing sector, have been somewhat generic. The captions used are predominantly determined by the SEC, leading to a significant variability in expense labeling and presentation across entities. Scope of the proposed guidance. The proposed update is primarily tailored for public business entities that file or furnish financial statements with the SEC. It's worth noting that private companies, not-for-profit entities, and employee benefit plans are exempt from this update. The core of this proposal is the disaggregation of expense captions that encompass specific natural expense categories. These categories span: inventory and manufacturing expense, employee compensation, depreciation, intangible asset amortization, depletion and amortization from oil and gas producing activities, DD&A. Real-world example: Amazon, a public business entity, would need to provide a breakdown of its expenses, detailing how much is spent on its warehouses, inventory and manufacturing expense, versus its corporate staff, employee compensation. Disaggregation of expense amounts. DISE provides a clear framework on how to disaggregate expenses for each required natural expense category. For instance, certain expense captions like the cost of products sold, cost of services, and SG&A would necessitate disaggregation. In contrast, others such as interest expense and income tax expense might remain aggregated. For each required category, the update proposes specific disclosures. Depreciation and amortization, the amount included in each caption on the income statement. Employee compensation, the amount included in relevant expense captions. Inventory and manufacturing expense, the amount separately disclosed. Qualitative descriptions for non-required categories. For expenses that don't neatly fit into the predefined categories, DISE introduces qualitative descriptions. These narratives offer additional clarity for investors, elucidating other amounts in relevant expense captions. Real-world example: if Netflix, known for its streaming services, incurs a unique content production expense not falling within the standard categories, a qualitative description would provide investors with insights into this specific expenditure. Addressing the inventory and manufacturing expense issue. Recognizing the challenges of disaggregating expenses due to inventory derecognition, the update proposes a distinct bucket for capturing costs in the manufacturing process. This bucket would be further broken down into specific categories, including purchases of inventory, employee compensation, depreciation, tangible asset amortization, and D&A. Cost-incurred approach. DISE champions a cost-incurred approach, mandating the disclosure of costs in the period they are incurred, irrespective of when the inventory is sold. This ensures a transparent view into current period production costs. Real-world example. If Tesla incurs costs in producing a new model of electric car but doesn't sell it until the next financial period, the costs would still be disclosed in the period they were incurred. Reconciliation of costs incurred to expenses recognized. Given that production and sales might not always align within a fiscal year, there might be discrepancies between costs incurred and the expense recognized in the income statement. To bridge this gap, entities would present reconciling items, such as foreign currency translation or inventory derecognition through business sales. Disclosure requirements. DISE introduces several pivotal disclosure requirements. Total selling expenses and their definitions. The stipulation that entities aren't mandated to disaggregate selling expenses unless presented as a separate caption on the income statement. New disclosures would predominantly be in the form of notes to the financial statements, applicable in both annual and interim reporting periods. Comprehensive disclosure example. To aid entities in navigating this update, a comprehensive disclosure example is provided, illustrating the proposed requirements. This serves as a reference point, elucidating how the update applies to various entity types. Real-world example. A pharmaceutical company like Pfizer might refer to this example to understand how to disclose its research and development costs versus manufacturing costs for its drugs. Conclusion. In essence, the proposed accounting standards update is a monumental stride towards offering investors a more detailed lens into income statement expenses. By adopting a cost-incurred approach and ushering in comprehensive disclosures, the update promises enhanced transparency, empowering investors to make more informed decisions about a company's financial health.